Have you ever found yourself scanning the headlines, seeing the S&P 500 closes up, or maybe checking a company's credit rating before making an investment decision?
Yeah, happens all the time.
Well, these aren't just abstract numbers, or fleeting data points. They're really the highly visible tip of this enormous, complex financial iceberg.
That's a good way to put it, an iceberg, dictating capital flows,
Yeah.
influencing decisions everywhere.
And today, we're taking a truly deep plunge into that iceberg, focusing on the titan behind so many of these essential financial metrics, data points, benchmarks, S&P Global.
Absolutely right. S&P Global, ticker SPGI. Their name might not always be splashed across the front page, but wow, their influence is pervasive.
Right.
They are truly a foundational player in global finance, providing what they call mission-critical intelligence.
Mission-critical intelligence, I like that.
Yeah, to the world's capital and commodity markets. Think of them as like the silent architects of the financial system.
Providing the bedrock for countless decisions.
Ex-
So our mission on this deep dive, it's really to go far beyond just understanding what S&P Global does. We want to unpack how they've become so incredibly integral, dissect their competitive advantages, their moats, as investors call them.
Yeah, the defensibility.
Explore their growth drivers, acknowledge the challenges they face, and, paint a picture of their future.
And we'll be looking especially through the lens of their recent Q2 2025 earnings report, right?
Exactly. We've got a stack of fascinating reports and that latest earnings update, giving us multiple perspectives. We're going to extract the most important nuggets to leave you truly well-informed. So let's get into it.
Okay, so when we talk S&P Global, it's, like you said, way more than just the S&P 500 index.
Much more.
SPGI is a leading provider of data, credit ratings, benchmarks, analytics, all absolutely essential stuff for capital and commodity markets worldwide.
Based in New York, right?
Yep, headquartered in New York. Their intelligence really powers investment decisions, financial planning, for basically everyone. Big institutions, corporations, governments.
Even retail investors indirectly.
Absolutely. It's a vast ecosystem they support.
What's really remarkable, I think, is how strategically diversified they are. They talk about their 5 pillars, their main business segment.
Right, the 5 pillars. Each one is a leader in its own field. It makes the whole enterprise incredibly resilient.
Let's start with market intelligence. This seems like a real powerhouse, offering multi-asset data analytics products like Capital IQ.
Oh yeah, Capital IQ is huge. If you're a financial analyst, investment banker, corporate strategist, chances are you're using it.
So what's it actually do for them?
Well, market intelligence provides this really comprehensive offering. It helps customers track performance, find investment ideas, understand industry dynamics.
Valuations, risks.
Exactly. Detailed valuations, manage credit risk across public and private markets. Imagine a private equity analyst looking at a potential acquisition.
They'd be digging deep with Capital IQ.
Totally. Digging into private company financials, industry benchmarks, it gets deeply embedded in customer workflows. We'll talk more about that stickiness later.
Okay.
And it boasts, get this, 96% recurring revenue with 84% from subscriptions. That shows just incredible client retention over the last few years.
Wow, 96% recurring. That's stability.
It is. This segment basically sells the most sophisticated tools and info to the financial industry. Helps them make better, faster decisions.
Okay, pillar number 2, ratings. This is probably the one most people do associate with S&P.
Yeah, definitely. It's one of the world's leading independent credit rating agencies. They're one half of that huge global duopoly.
With Moody's being the other half.
Precisely. They give these critical credit assessments for, well, a massive range of fixed income stuff. Corporate bonds, sovereign debt.
Like country debt.
Yep, nations.
Yeah.
Municipal bonds for local governments. Complex structured finance products. If you're issuing debt publicly, you're almost certainly dealing with them.
So how do they make money there? Is it just when a bond is issued?
It's a mix. They get transaction revenue, which includes fees for rating new issues, like a company floating a new bond or a government issuing debt.
Okay.
But they also have non-transaction revenue. That covers ongoing stuff like credit rating surveillance.
Basically, keeping an eye on the issuer's creditworthiness over time.
So it's not just a one-off.
Not at all. Plus annual fees from customer relationship programs. So it's a blend. You get that cyclical upside when bond markets are busy.
Right.
But also steady recurring income from the surveillance side. It underlines how critical and ongoing their role is. It's part of the infrastructure.
Makes sense. Next up is commodity insights. This used to be Platts, right?
That's right, formerly Platts. This segment provides truly critical price benchmarks and market info for energy, raw materials globally.
So oil, gas, metals.
Oil, natural gas, metals, agricultural products, shipping all the foundational things that literally fuel the global economy.
So traders, shippers, producers, they all rely on this. Absolutely. Yeah. These benchmarks are fundamental for trading, shipping, production, even consumer goods companies.
How fundamental are we talking?
Well, think about Brent Crude, that benchmark owned by Platts.
Yeah.
It prices about 2/3 of the world's globally traded crude oil.
2/3?
Wow. It's not just data. It's the agreed-upon truth for billions in transactions daily. Imagine a company like Hershey needing to lock in cocoa prices months ahead.
To manage their costs.
Exactly. They rely on these precise, trusted Platts benchmarks. They literally can't operate or hedge effectively without them. This information is essentially the language of global commodity markets.
That's powerful. Okay, fourth pillar, indices. This is where the S&P 500 and the Dow Jones live.
Yep, the iconic S&P 500 and Dow Jones Industrial Average. But they offer over 130,000 equity and fixed income indices globally.
130,000.
Staggering. And they are a core enabler of the booming ETF market.
Right, the exchange-traded fund. So when you invest in an S&P 500 index fund,
S&P Global essentially gets a small cut, a licensing fee for using their intellectual property. It's a brilliant, really scalable business model.
how does that scaling work?
Well, this segment makes money primarily through asset-linked fees. They're tied to the assets under management, the AUM, of ETFs and mutual funds tracking their benchmarks.
Ah, so as the funds grow, their revenue grows.
Exactly. They also earn from exchange-traded derivatives, licensing fees for custom indices, specialized data, and what's remarkable is how capital light it is.
Meaning they don't need to invest much to grow it?
Precisely. They create the benchmark, others pay to use it. It scales directly with market growth and the rise of passive investing without huge additional operational costs for SPGI.
Very smart. And the final pillar, mobility. What's covered here?
Mobility provides data and analytics for the entire vast automotive ecosystem.
A whole thing.
Pretty much. We're talking everything from EVs, the used car markets, which are constantly changing, to cutting-edge auto tech.
Who uses this?
Everyone from OEMs, the car manufacturers,
Right.
to insurers, fleet operators. It's a really comprehensive view of how cars are designed, made, sold, used.
Where does that data come from?
A lot of it comes from extensive data sets like bulk registration data. Tracks 650 million vehicles over 30 years of owner history.
650 million vehicles.
Yeah, so imagine an OEM trying to predict demand for certain models or a city planning EV charging infrastructure. This data is indispensable.
And it gives them an edge with all the changes happening in auto, like EVs.
Definitely. This integrated data offers a significant head start as the industry goes through these massive shifts. Electrification, software-defined vehicles. Mobility's core products are crucial. They serve nearly every major OEM, most top suppliers, and a majority of North American dealerships.
Dealerships are big customers then.
Huge. Dealers account for about 60% of their mobility revenue.
Okay, so you put these 5 segments together. Market intelligence, ratings, commodity insights, indices, mobility.
And you see the incredible power of diversification. These segments generate truly resilient, high-margin revenues.
Able to weather different economic cycles.
Exactly. It's not often you find a company that can thrive when bond markets are hot and when equity markets are booming and when commodity prices are volatile.
All while supporting this evolving auto industry.
It really is a testament to their strategic positioning.
So that really drives home why their intelligence is mission critical.
It does. They provide the foundational data, the benchmarks the global financial system relies on daily.
Without it, things would be much harder. Assessing risk, tracking performance.
Making informed decisions across all these diverse sectors. It would be significantly harder, maybe even impossible on a global scale.
So for investors, big institutions, or even individuals,
It's essentially a shortcut to being well-informed, providing that trusted bedrock for countless financial activities.
Okay, great overview. With that big picture, let's zoom in on their recent performance. We just got that Q2 2025 earnings report. How did they do?
Looked pretty solid. They delivered some really good growth across the board. Total revenue was up 6% year over year, reached $3.755 billion.
And you mentioned the subscription model earlier. How did that hold up?
That was notably strong. Revenue from subscription products grew an even better 7% year over year.
Okay, so that recurring revenue is still growing nicely.
It is, and that's a fantastic indicator of client stickiness, predictable revenue. It means a big chunk of their income is insulated from immediate market swings. Really vital.
And profitability. Did costs keep pace, or did profit to grow faster?
Profits grew faster. They saw robust profitability expansion. Adjusted operating profit was up 7% year over year.
Nice.
And adjusted diluted EPS, earnings per share, grew an impressive 10% to $4.43.
10% EPS growth. Those are strong signals. They're not just growing the top line, they're doing it efficiently.
Absolutely. And the key drivers, particularly strong growth in market intelligence, that was up 5%.
Okay.
And an outstanding 15% increase in S&P Dow Jones indices.
Wow, 15% in indices. The equity market enthusiasm really helping there.
Clearly demonstrates the strength of their diversified portfolio playing to current trends, equities, and data-driven insights.
And what about returning value to shareholders? Any news on dividends or buybacks?
Yeah, they're committed there.
Yeah.
Returned nearly $950 million through dividends and share repurchases in Q2 alone.
Just in Q2.
Just in Q2. And they have a stated commitment to use 85% or more of their free cash flow for this.
That's a significant return.
Plus, they're expecting additional accelerated share repurchases, ASRs, of up to $1.3 billion soon. That's a serious commitment.
They're also making some strategic moves, right? Separating mobility.
Correct. They're continuing to execute on strategic initiatives to optimize the portfolio. The planned separation of mobility is still on track.
And they have a leader picked out.
They do. They appointed Bill Eager, who's currently the CEO of Carfax, as the CEO designate for the planned standalone public company.
Interesting choice.
And their OSTTRA joint venture divestiture, that's also on track for completion in the second half of 2025. So, moves to streamline focus, optimize for future growth.
Okay, so the numbers look strong, diversification is clear, but I keep coming back to that mission-critical intelligence. What really makes them so indispensable? Where are those moats?
The moats, yes. This is where the long-term value story really is.
Because this industry, it has incredibly high barriers to entry, right? Deeply entrenched dynamics. Not easy for newcomer.
You've hit the crucial point. Let's start with that dominant duopoly in credit ratings.
S&P and Moody's.
Exactly. Together, they control about 80% of the global credit ratings market. Fitch is a distant third, maybe 10%.
Just 10% for the third player. Wow.
Yeah. This oligopoly gives both SPGI and Moody's substantial pricing power and strong protection because of the trust, the regulatory approval they've built over decades.
And there's this dual rating advantage you mentioned. Tell me more about that.
Right. So clients, especially big institutions, often get ratings from both SPGI and Moody's for the same bond issue.
Why both? Wouldn't they just pick one?
It's not really about fostering competition between them. It's about meeting regulatory and investor requirements. Many big investors are legally required, or by their own internal policies, to only invest in bonds that have at least 2 investment-grade ratings from recognized agencies.
Ah, so having both S&P and Moody's is almost mandatory for issuers who want the widest possible investor base.
Precisely. This dynamic actually reduces direct pricing pressure between the two giants and boosts retention for both. S&P isn't just selling a service, they're selling an essential regulatory checkpoint.
Like a toll booth you have to pass through.
Almost like a government-mandated service, but run privately. It's an incredibly powerful moat.
And it actually saves the issuers money in the long run. That seems counterintuitive.
It does. Getting an S&P rating might add, say, 8 basis points, 0.08% to issuance costs. Seems like an extra expense.
Yeah.
But not having a reputable rating or using a lesser-known firm, that can inflate legal fees by maybe 75 to 125 basis points and widen the interest spread they have to pay by up to 300 basis points.
So the cost of not getting the rating is far higher.
Far higher. Securing an SPGI rating actually leads to net cost savings, anywhere from 30 to 65 basis points typically. It really is like paying a toll booth that saves you money by lowering your borrowing costs and boosting investor confidence.
Incredible incentive. And then there's the regulatory side.
Huge. Significant regulatory entrenchment. S&P Global is approved by the SEC, international counterparts. Their role is effectively irreplaceable in the financial infrastructure.
Because their system is the standard.
Exactly. Their rating system, the scale, it's the industry standard. It creates this self-reinforcing loop. Trustworthiness brings more use, which reinforces trust, making it incredibly hard for any new player to get the traction, trust, or regulatory nod needed.
Okay, that's a deep moat. What about the iconic presence in the indices market?
Another deep, deep moat, provider of the S&P 500, the Dow Jones, globally recognized brands.
Synonymous with the market?
Pretty much. When someone asks, how did the market do today? They're almost certainly talking about an S&P index. This gives them immense brand value and directly influences massive passive investment flows.
Which ties into the passive investing boom.
Directly. AUM and ETFs. It's ballooned past $10 trillion globally.
$10 trillion.
And that directly benefits SPGI through those licensing fees we talked about. Passive investing is now over 45% of U.S. fund assets, and that trend just keeps going.
So billions are flowing into products that pay S&P Global just to use their index name.
That's the model. And the U.S. market dominance helps. S&P indices are highly concentrated in the U.S., still the biggest, most influential market. Look at the top ETFs by assets.
IVV, SPY, VOO.
All S&P 500 index funds from different providers underscores S&P's critical role, and it creates network effect.
Meaning the more people use it, the more valuable it becomes.
Exactly. The more funds, ETFs, financial products track the S&P 500, the more it reinforces its status as the benchmark, solidifying its brand, its competitive position. A truly virtuous cycle. It grows exponentially.
Okay, powerful. Next moat. Quasi-monopoly in commodity benchmarks. Back to the old Platts business.
Right. Commodity insights. Providing integral price assessments. Oil, like Brent crude.
Which prices 2/3 of global crude traded internationally.
Astonishing amount, yeah. Plus natural gas, metals, shipping. So if someone's betting on oil prices,
they're essentially betting on what Platts is saying.
Pretty much. These aren't just suggestions. These benchmarks are foundational to global commodities trading and procurement.
And hard to switch away from?
Immense switching costs. Imagine businesses having to rewrite countless contracts, thousands of agreements that rely on Platts' standardized pricing.
Nightmare.
It creates incredibly high switching costs. And those network effects, again, the more businesses use them, the stronger their position as the industry standard.
Yeah.
Platts benchmarks are the universal language for these markets.
Do they have competitors here?
They face some competition, yeah. Argus Media is a notable one, especially in Europe, Latin America.
Yeah.
But SPGI largely dominates North America and Asia, partly due to broader global trust, partly the sheer muscle of the S&P Global brand.
So businesses must use these benchmarks. It's not optional.
For efficient function in these markets. It's a core necessity, not an add-on.
Okay. What about the defensive niche in market intelligence? You said this area is more competitive.
It is definitely more fragmented. You've got strong rivals like Bloomberg, FactSet, Refinitiv, which is now part of LSEG. It's a tough arena.
So where's S&P's edge here?
They've carved out a distinct edge, offering a cost-effective, enterprise-friendly alternative. Deeper capabilities in areas like private market intelligence, comprehensive ESG scoring, fundamental research via Capital IQ.
And the integration helps.
Big time. Their solutions are designed to integrate seamlessly into complex enterprise workflows, which makes them incredibly sticky.
How sticky are we talking? You mentioned 96% recurring revenue earlier.
Right, and that reflects a 96% retention rate overall for market intelligence. Average customer partnerships last 20 years.
20 years?
Yeah, their solutions are so deeply integrated. Switching means massive operational changes, retraining staff, significant costs. For these financial giants, switching data providers isn't just an IT project.
It's like open heart surgery on their operations.
Exactly. The cost and risk of disruption dwarf any potential savings, locks them in for decades. And the sheer scale of data, 58 million documents, 50+ million private companies. Quality and trust are paramount. Even cheaper alternatives aren't worth the risk for critical stuff.
Makes sense. Finally, the first mover advantage in automotive data analytics mobility, benefiting from the IHS Markit acquisition.
Significantly. IHS Markit brought a strong legacy here, established relationships.
And they covered the whole supply chain.
Pretty much. Integrated data and analytics across the entire automotive supply chain gives them a crucial head start in this massive industry transformation. EVs, software-defined vehicles.
Using data like the Polk registrations.
Exactly. Key products like Polk registration data, 650 million vehicles tracked, 30+ years of owner history. It's not just counting cars. It's understanding ownership patterns, predicting trends, informing strategy for OEMs, dealerships.
And you said dealerships are key customers?
Yep, about 60% of mobility's revenue. This data is crucial for the industry. Serves nearly every major OEM, most top suppliers, majority of North American dealers. This reach and integration make them indispensable in an evolving sector. Online sales, EVs, autonomous driving, they're right in the middle of it.
Okay, so we've covered the what the essential services and the why, those deep moats. Now let's shift to the growth drivers. What's pushing SPGI forward? Even fortified castles need new territory.
Right, starting with the big picture. Favorable macroeconomic tailwinds for the industry. We're seeing this sustained boom in financial market participation post-COVID.
More people investing.
More people investing, record inflows into asset classes, the explosion of ETFs, it all entrenches benchmark providers like SPGI. It's a fundamental shift, and they're at the heart of it.
So if you hold an S&P 500 fund,
You're indirectly boosting their bottom line through licensing fees. It's a quiet, powerful engine.
and beyond individuals, there's this expanding data demand.
Huge demand from traditional users like asset managers, insurers, regulators,
Mm-hmm.
but also a new wave of fintech companies. Portfolio management is getting more algorithmic, more data-driven.
Driving demand for analytics, ratings.
Proprietary analytics, credit ratings, especially specialized ESG insights. The financial analytics market alone, projected to grow at, 12.5% CAGR through 2030.
That's compound annual growth rate.
Right, reaching over $21 billion annually. That's a
Yeah.
massive addressable market, still growing fast.
And it's not just public markets, right? Private market and ESG data is hot too.
Incredibly so. Private equity, VC, private credit, they're getting more sophisticated, demanding specialized data sets, benchmarking tools for unlisted companies, alternative assets.
And S&P's AI integration helps here.
Positions them well. Their focus on integrating AI into analytics platforms makes them a critical enabler. ESG and private markets are expected to grow even faster, double-digit KGRs through 2030. Huge opportunities.
Here's one that surprised me. China's financial liberalization. How does that help SPGI?
It's a significant growth lever.
Yeah.
China's gradually reopening, internationalizing its bond and credit markets.
Those are enormous.
Massive. U.S. $24.3 trillion in bonds. Outstanding. Huge opportunity. And especially after Moody's recently downgraded China's sovereign outlook to negative. SPGI is well positioned. They could potentially offer more favorable ratings without losing credibility, appealing to Chinese firms wanting investor confidence as they seek international capital. Fills a potential void.
Interesting dynamic. Now let's talk about that IHS Markit deal again. You said the post-acquisition synergies driving profitability have been key. How so? Integration is usually tough.
It is notoriously tricky. There was investor caution initially,
Right.
cultural fit, operational overlaps. But the post-merger reality has far exceeded expectations. It's been a masterclass in integration.
What made it exceed expectations? What clicked?
It really came down to complementary strengths and a clear vision. S&P Global was dominant in desktop solutions. Credit analytics think 100% of their desktop data delivery for analysts.
Okay.
IHS Markit, meanwhile, brought robust enterprise software, workflow tools, 99% of their enterprise solutions, expertise for big institutions.
So different strengths, different delivery models.
Exactly.
Yeah.
It wasn't just combining data, it was combining delivery methods and expertise. Created this powerful end-to-end data and analytics ecosystem. Asset management, ESG, commodities, private markets. Gave clients a holistic solution, not just pieces.
So smarter, not just bigger.
Precisely. And this integration led to an expanded total addressable market, TAM. They identified an incremental TAM of about $20 billion.
Wow.
With average market growth over 10% across the combined verticals. Think ESG metrics, private market intelligence, energy transition analytics areas where both had complementary capabilities, now bundled and cross-sold.
And that cross-selling success is actually happening, getting clients to buy more.
Absolutely. Market intelligence especially saw accelerated multi-product licensing, enterprise-wide subscriptions, custom analytics contracts.
Like a Capital IQ user adding ESG data?
Exactly. Someone using Capital IQ for public data might now add IHS Markit's private equity insights or ESG scoring. Doesn't just boost revenue per client, it enhances margins too. Bundling reduces incremental servicing costs.
Then they're hitting those synergy targets.
They are. Management targeted $350 million in revenue synergies by 2024. The latest Q2 25 earnings show strong progress, a run rate of $332 million, targeting the full 350 meters by late 25 or early 26. You see it in areas like energy transition and sustainability revenue, up 7% year over year, and private market solutions, up 11%.
Yeah.
Shows where it's taking hold.
Finally, undergrowth drivers, their diversified revenue streams. This provides resilience, right?
Incredibly resilient foundation. The model balances stability and growth through various income sources across those 5 segments, like multiple engines on a plane.
Okay, break down those streams for me.
Sure. In fiscal 23, 52% of total revenue came from their subscription model. That's the cornerstone. Predictable, recurring cash flow.
Like market intelligence at 84% subscription, commodity insights at 87%.
Exactly. Leads to that high client stickiness, better forecasting. It's the stable foundation.
Then there's transaction-based revenue. That was 21% in FY23.
Yep. Provides operating leverage when financial activity is high. Ratings is the prime example. 53% of its 23 revenue was transactional from bond issuances.
So when bond markets are hot, ratings takes off.
Exactly. Benefits from market recovery, future refinancing waves as rates change.
What about non-transaction revenue?
That was over $2 billion in FY23. Includes long-term contracts for data, custom analytics, regulatory feeds, multi-year deals, especially in energy trading, banking. They anchor long-term visibility, business continuity, steady cash flow, even when markets are volatile, locked-in revenue.
And the last piece, asset-linked fees from indices, 7% of revenue in FY23.
Right. About $1.05 billion from S&P Dow Jones Indices. Incredibly scalable. Benefits directly from passive investing trends. As global ETF AUM grows,
Their revenue scales organically.
organically with market appreciation, new product launches, minimal extra servicing costs, it's like printing money as the market grows.
So this multi-segment structure really insulates them.
Adds significant resilience. Diversified end market exposures, auto, energy, credit, investment management. Insulated from risks in any single business line. If bond issuance is low, maybe mobility or commodities compensate. Market intelligence offers consistency in volatile equity markets, makes their overall revenue profile highly defensive.
Okay, but even defensive companies face risks. Let's talk about navigating the landscape. How do they mitigate potential pitfalls? First big one, slowdown in global financial market.
Absolutely. Sharp interest rate spikes, prolonged inflation, a big downturn can really hit liquidity investor activity.
We saw that in 2022, didn't we, with the bond market?
Vividly. The bond market downturn led to a huge reduction in issuance, over 30% for investment grade, over 80% for high yield. That significantly hit SPGI's ratings revenue. It's a real danger.
So how do they buffer against that cycle, especially with transactional parts of the business?
The key mitigator is that strong subscription-based revenue, 52% of total revenue in FY23.
Market intelligence, commodity insights, over 80% recurring.
Exactly. That ensures predictable cash flows, acts as a stabilizer, lets them weather financial storms much better than peers who are more reliant on transactions, provides a solid floor.
Okay, next big question, really for everyone these days. AI reducing the need for traditional data and solutions. Could generative AI eventually disrupt providers like S&P?
It's a legitimate concern, definitely. Automated data generation, analysis tools from fintech tech giants, could they reduce demand?
So what's S&P doing? Are they just watching?
No, not standing still. They're deeply committed to integrating AI capabilities into their own products. Think intelligent features in Capital IQ Pro, their ESG solutions, leveraging NLP, predictive analytics.
So they see AI as an enhancer, not a replacement.
That seems to be the strategy. Augmenting human workflows, not replacing them. For instance, internal AI tools like Spark Assist adoption jumped from 30% to over 65% of their people.
Wow.
Internal use cases, Sparks, grew from 1,300 to over 3,000. New products like Credit Companion for Ratings Direct use NLP, LLMs, to help credit analysts with research, summarization. Spice Index Builder creates custom indices in days, not weeks.
So making their existing services better, faster.
Exactly. And their focus remains on trust, regulatory alignment, providing structured, high-quality, verified data. That becomes even more essential in an AI world flooded with information, right? Trust and accuracy are paramount.
That makes perfect sense. You need a trusted source even more when info is overwhelming. What about regulatory and compliance risk? With their dominance, they must face scrutiny.
Constantly. Regulators in the EU, US frequently review mergers, worry about financial data oligopolies.
So how do they manage that?
Proactively. For the IHS Markit deal, they actually divested assets like CUSIP Global Services, the identifier system, to address specific regulatory concerns. Shows they're willing to make significant concessions.
So they trim down to stay in good standing.
Seems so. They engage transparently with policymakers, emphasizing their role in market transparency, not obstruction, ensuring compliance with evolving rules like EU and UK CRA regulations. It's about being seen as a responsible leader.
Okay. Let's address some potential concerns from analyst reports. One was increased debt post-acquisition from IHS Markit. Debt always worries investors.
It does, and they did use debt for the acquisition. But their cash flow is expected to rise significantly as synergies kick in, their debt-to-EBITDA ratio.
Earnings before interest, taxes, depreciation, amortization.
Right. It remains well below the common threshold of 3x. Interest expense is manageable, maturities are spread out, and management's committed to aggressive share buybacks to offset dilution. Shows a clear path to managing the debt.
Another concern was a temporary drop in return on capital employed, ROCE, that efficiency metric.
Yeah, ROCE dipped. But this is common, even expected after large acquisitions. It's due to the premium paid for acquired intangible assets. It increases capital employed before earnings fully catch up.
So it's an accounting effect.
Largely. Historically, SPGI has had consistently high ROCE, 5-year average over 24%, 10-year over 31%. Management expects the deal to be accretive, earnings enhancing over time. The drop is seen as temporary.
And share dilution from issuing stock for the deal.
Also being actively mitigated. Those accelerated share repurchases are offsetting the shares issued. Plus, that commitment to return 85% plus of free cash flow via dividends and buybacks shows discipline, focus on shareholder value. They even ramped up buybacks during the 2022 crash when the stock was down. Smart move.
Okay, let's look ahead. The future catalysts, valuation, and what lies ahead. What are the confirmed catalysts pushing SPGI forward now?
Well, the most immediate is that positive quarterly earnings confirmation in Q2 2025. It's real-time validation. Reinforced confidence, improved guidance, confirms execution, especially in growth areas like market intel and indices, tells us they're delivering.
And those IHS market synergies. Still more juice to squeeze there.
Absolutely. Continued realization, potentially exceeding synergy targets, is a major catalyst. They aimed for $350 by 24, might beat it by late 25 or 26, drives faster top-line growth, higher margins, powerful lever for value.
What about the broader markets? Equity and bond market exuberance for 25-26.
Looks like a nice tailwind. Continued bull market in equities helps indices via AUM growth. Declining interest rates could reignite fixed income, boosting ratings transactional revenue.
Dual tailwinds.
Could materially lift revenues.
Yeah.
Interestingly, the Q2 25 guidance update slightly lowered expectations for commodity insights, but raised them for ratings, indices, and mobility. Shows that diversification working, pivoting to stronger currents.
Sounds positive. How about management quality and capital allocation? Leadership stable.
This seems very stable, experienced leadership, long tenures. The CEO, Martina Chung, 15 years with the company, fosters stability, deep knowledge. And their communication and reports is sharp, non-marketing, lets numbers speak.
And capital allocation, what do they do with the cash?
Disciplined, efficient. Very low CapEx needs. They sell data, IP, not build factories. Commit to returning 85% plus free cash flow to shareholders via dividends, buybacks.
And they buy back shares smartly.
Historically, yes. Ramping up during the 22 crash showed intelligent deployment, buying when cheap. Plus, management pay is tied to adjusted EPS growth. Aligns interests with shareholders.
Okay, the big question, valuation perspectives. Great company, but is it a good price? There are conflicting views here.
That's why it makes it interesting. One report sees significant upside potential, talking 98% 5-year potential upside. Implied share price range $408 up to $765 from around $500 now.
Suggests a good risk reward.
Favorable, yeah. Risks $1 to potentially gain $2.85, according to that view. Compelling.
But another analyst has valuation concerns. What's the worry?
Yes. Points to the current PE ratio, price to earnings, around 40x.
Ish.
Suggests it already implies steady 10-15% earnings growth baked in. Warns of a potential derating the market, applying a lower multiple down to maybe 20-25x PE in a recession.
Which would cause a big drop in the stock price.
Could lead to a large drawdown, like in 2022 when the PE fell from 36x to 22x. Took 10 months to recover. So growth prospects are strong, but the current price might already reflect a lot of that success.
What's the historical PE context? Is 40x crazy high for them?
The 5-year historical median PE is around 37x. So 40x is a bit above that, but not wildly out of line historically. But it leaves less room for error if growth stumbles. That's the concern.
Makes sense. Finally, let's think about the predictability of segments going forward. Some seem rock solid, others maybe less so.
Definitely varies. Ratings, indices, and commodity insights are seen as highly predictable. Entrenched status, regulatory protection, network effects, time only strengthens them.
The world will always need ratings, benchmarks, commodity prices.
Pretty much. These segments are here to stay and grow. Reliable third-party assessment, industry standards, agreed-upon prices, essential.
What about market intelligence? More vulnerable to tech changes.
Generally predictable short to medium term. High retention, scale, data quality help. But long term, say 15 plus years.
Yeah.
Subject to AI disruption if they don't innovate fast enough.
Or they need to keep evolving that segment.
Absolutely. Strong head start with proprietary data, customer integration, but the competitive landscape is more dynamic there.
And the hardest to predict segment has to be mobility.
Clearly, mobility faces the most uncertainty. Rapidly evolving auto industry. Online sales, EV transition, self-driving cars, dealer relevance.
So many moving parts.
Exactly. Less clarity on competition, fundamental industry shifts. Its long-term trajectory is the most complex to forecast, requires constant adaptation.
Wow, we've really unpacked a lot today, peeling back the layers on S&P Global.
We have.
We've seen how it's truly an unseen architect of markets, providing that mission-critical intelligence across incredibly diverse segments.
The moats are formidable. Strategic use of acquisitions like IHS Markit, proactive AI integration, discipline management, it all contributes. A powerhouse built on trust and indispensable data.
Indeed, S&P Global thrives on information, providing the bedrock for countless financial decisions, ones you might not even realize you're connected to. Their reach is profound.
An indispensable component of the global financial system. A foundational layer, often unnoticed until you really stop and think about the sheer volume of activity relying on their data.
It really makes you think, doesn't it? In a world drowning in data, S&P Global acts as this trusted filter, this foundation, providing signal amidst the noise. But as AI keeps evolving, promising to democratize information, potentially making all data instantly understandable, universally accessible, what does that mean for the value of traditional mission-critical intelligence?
And the gatekeepers who provide it.
Exactly. Will the brand and trust of institutions like S&P Global become even more paramount in differentiating signal from noise? Or will a whole new paradigm emerge, one where the source matters less than instant utility?
That's a fascinating question. Something for you to ponder as you navigate your own financial world.